Hello guys, welcome to my channel. So today I would like to explain to you guys about what is cash flow statement. But first, let me introduce myself. My name is Japhanie Cole. I'm from UIB.
Alright guys, today's topic is about statement of cash flow.
The first thing that you need to know is what is statement of cash flow. Statement of cash flow is a report of a firm's major cash inflows and outflows for a period. It provides useful information about a firm's ability to generate cash from operation, maintain and expand its operating capacity, meet its financial obligation, and pay dividend. As a result, it is used by managers in evaluating past operation and in planning future investing and financing activities. It is also used by investor, creditor, and others in assessing a firm's profit potential. In addition, it is a basis for assessing the firm's ability to pay its maturing debt. So here we've got four purposes of statement of cash flow. Provides information about cash inflow and outflows during a period. Provide information about cash changes between two balance sheet debt. Disclose items that affect the balance sheet but don't show up in the income statement. Categorize changes as operating, investing, or financing activities. So in preparing statement of cash flow, information for this report is collected from a variety of sources. So in preparing this statement of cash flow or this report, we need three items: a comparative balance sheet or a comparative statement of financial position, an income statement, and additional information on changes in account balance. So here we got the cash change equation. So normally we have cash equation is asset is liability plus equity. But here cash is one of the asset. So cash plus non-cash asset is liability plus equity. So we can conclude that in cash is liability plus equity minus non-cash asset. So there are three classifications of cash flow activities. First is operation, second is investing, third is financing. Operation is cash flow related to selling goods and services, that is the principal business of the firm. Investing is cash flow that related to the acquisition of or sale of non-current asset. Example, we buy fixed asset. And financing is long-term and short-term cash flow related to liabilities and owner equity, dividends, or financing cash outflows. So there are two methods in preparing cash flow statement: the direct method and indirect method. Direct method is calculates cash flow from operation by subtracting cash disbursement to supplies, employees, and others from cash received from customer. An indirect method is calculate cash flow from operation by adjusting net income for non-cash revenue and expenses. And most of the firms use indirect method. Reporting cash flow from operating activities. Direct method. Operating activities include acquiring and selling product in the normal course of business. Different types of businesses will have different transactions that are included in cash flow from operating activities. Types of operating inflows of cash is sales to customer, collection of cash from past sales that made on credit, interest and dividends received. And types of operating outflows of cash is purchase of merchandise, of sale or material to manufacture products, payment for operating expenses, interest on debt, and payment for services and taxes. Reporting cash flow from operating activities indirect method. Net income plus non-cash expenses plus increases in current liabilities plus decreases in current asset minus increases in current asset minus decreases in current liability minus gains from investing and financing activities plus loss from financing and investing activities. So the differences between indirect method and direct method is on the operating activities. The investing and financing is same. So type of investing inflows of cash is sales of property, plant and equipment, the sales of securities, stocks and bonds of others company, the receipt of loan payment. And investing cash outflow from company is purchase of property, plant and equipment. Like what I said before, we purchase fixed asset, purchase of securities and making loans as investment. And financing inflows, selling stock, issuing bonds, contribution from owners, borrowing from bank and long-term basis. And the outflows of financing is repayment of notes and bonds, cash payment to repurchase stock, payment for dividends. So here I've got the Gold Corporation balance sheet or financial position, a comparative one, the first year and second year. And here is the Gold comparative income statement and some information about what we have done in this year. So here is the Gold Corporation statement of cash flow. So we can see the net income is 84,000. We got it from here. And add or deduct depreciation and amortization expense. So here we use the transaction that non-cash related. Net income is not a net cash, so we have to deduct or add or adjust with the non-cash transaction. So first thing is depreciation and amortization expense. We got it from here, 35,000. Gain on sale of asset like here, 5,000. Account receivable is 9,000 decrease. Here we see the first year is 39,000, second year is 48,000. So we have increasing the receivable is 9,000. But in statement of cash flow, we decrease it. We minus it. Because that is how it works. For the non-cash asset, if they are increasing, so we need to minus it. But if they are decreased, we have to plus it in statement of cash flow. and for the liabilities and equities, if they are decreasing, we have to minus it at statement of cash flow. If they're increasing, we have to plus it from statement of cash flow. Like what I told you before in the PPT is this cash change equation. So we are back. Here, inventory 6,000. From here, the changes. Prepared expense 3,000 from here. Account payable, accrued expense is from here. Okay. So we have net cash flow from operating activities. It's a total from this. So we jump into investing activities, purchase of equipment. Here, the company purchased a truck during the year at a cost 70,000. Sale of equipment 7,000. So a truck with a cost of 10,000 and a net book value is 2,000 was sold during the year for 7,000. So we got net cash flow from investing activities. Move on to the financing activities. We got here mortgage payable 150,000, preferred stock 170,000, 75,000. Dividend is 51,000. Actually, this dividend we can get it from this retained earning and net income. As you can see, the changes here is 33,000. So we minus it. We use the net income 84,000 minus 33,000. Get it. The dividend is 51,000. So we plus the increase of cash is the sum of these three. Beginning cash is 51,000. Here we can see the year one. So we got the ending cash is 75,000. Here. So this is the cash flow of direct method. We have three sections here: operating activities, investing activities, and financing activities. Like what I told you before, the investing activities and financing activities is same with indirect method. As you can see, purchase of equipment 70,000, sale of equipment 7,000, same. Mortgage payable, preferred stock, dividend. With this one, also same. The only one that makes two methods different is the operating activities. At here we compare the net income and other else account with our cash. But at here we just written down the physical activities that happen. cash receipt from customer is 651,000. This amount we got it from sales itself, 660,000 minus account receivable 9,000. And this cash paid for inventories, the amount is got from this cost of sales, 363,000 minus inventory, minus decreasing inventory, 6,000, and plus the account payable, 5,000. So the amount is 362,000. And for this operating expenses, we got it from here, 183,000. You can see 183,000 minus the prepaid expenses and the accrued expenses. So the amount is 176,000.